More than 1 million Florida homeowners have seen their property taxes rise in just the last few years. And for many families, that single bill now costs more than a month's income. Here's the unsettling question. What if the home you worked your entire life to own can be taken from you? Not by burglars, not by banks, but by paperwork. In Florida, you don't have to lose your job, break the law, or make reckless choices to lose your house. You only have to fall behind on one tax notice you didn't understand, one reassessment you never expected, or one increase your income couldn't outrun. This isn't about luxury mansions or careless investors. It's happening to teachers, retirees, and working families who did everything right. Property tax has become a silent predator. It doesn't knock, it doesn't warn, and it doesn't care how long you've lived there. Stay with me, because the next few minutes could be the difference between protecting your family's future or watching it slip away. Number 10. The silent foreclosure path. Most people imagine losing a home as a loud, dramatic event. Courtrooms, lawyers, final warnings, and a bank knocking on the door. But in Florida, property tax foreclosure doesn't look like that. It's quiet, mechanical, almost invisible. If you miss a property tax payment, the county doesn't immediately take your home. Instead, a tax certificate is sold to an investor. That investor now earns interest on your debt. To you, it feels like nothing has changed. You still live there, the lights are on, life goes on, but the clock has started. After a set period, that investor can apply for a tax deed sale. Your home is then auctioned publicly, often online, sometimes without you ever fully understanding what's happening. No judge weighs your story, no bank negotiates. The system simply executes. Families discover too late that their house was sold for a fraction of its value to cover a tax bill smaller than a used car. This is why it's so dangerous. It doesn't feel like a crisis until it's irreversible. A single missed notice, a wrong address on file, or a year when money was tight can quietly place your home on a conveyor belt toward loss. Generational homes disappear this way. Retirees lose paid-off houses this way, not because they were reckless, but because the process was designed to be silent. If this shocked you, it should. These systems were built for efficiency, not mercy. And awareness is your first line of defense. If you own property in Florida, do yourself and your family a favor. Check your tax status today, set alerts, and learn how your county handles tax certificates. And if you know someone who owns a home, especially a senior, share this with them. One click could protect a lifetime of work. Like this video, subscribe for more guides that keep families informed, and tell me in the comments, did you know property taxes could take a home this way? Number 9. The rental property trap. For many families, rental property isn't a luxury, it's a retirement plan. It's the backup when pensions fail, the bridge between working years and old age, the asset meant to pay medical bills or support children when times get hard. But Florida's property tax system quietly turns that safety net into a pressure cooker. Unlike primary residences, rental homes receive fewer protections. There is no meaningful homestead shield. When property values rise, rental taxes often jump faster and higher. Landlords are told, just raise the rent, but reality doesn't work that way. Tenants, already stretched by inflation, can't absorb endless increases. Every tax hike compresses the margin. Insurance climbs, maintenance rises, and suddenly, a property that once provided stability begins to bleed cash. Owners are forced into impossible choices: raise rent and risk vacancy, or hold prices and slowly go underwater. Over time, many sell, not because they want to, but because the math no longer works. This is how generational assets vanish. A home meant to fund college becomes a liability. A duplex meant to cover retirement becomes a burden. And the most dangerous part is how gradual it feels. Each increase seems manageable. Each year feels survivable, until one season tips the balance. One reassessment, one storm, one repair paired with a higher tax bill. The property that was supposed to protect the family becomes the thing that drains it. Florida's tax structure quietly rewards scale and punishes small owners, pushing property into fewer, larger hands. The result is not just financial strain, it is the slow erosion of family independence. What begins as passive income ends as active anxiety, where every envelope from the county carries the weight of an ultimatum: adapt or lose the future you were building. Number 8. Gentrification pressure. In Florida, you don't have to renovate your home, flip it, or cash in on rising prices to pay the cost of growth. Sometimes all it takes is for someone else to upgrade the neighborhood. A new shopping plaza, a luxury condo project, a rebranded revitalization zone. These changes may look like progress on paper, but for longtime residents, they often arrive as a financial shock. Property values rise not because you ask them to, but because the market around you changed. And when values rise, taxes follow. The family that bought their home 20 years ago in a quiet working-class area suddenly finds themselves living in what the county now labels a hot neighborhood. Their house may still be modest, their income unchanged, but their tax bill now reflects the new version of the area, not their reality. This is how people get priced out of places they helped build. The pressure doesn't come as eviction notices or rezoning battles. It comes as math. A few $100s more each year, then $1,000, then another jump. What once felt affordable becomes a monthly stress. Seniors begin skipping repairs. Families delay medical care. People who plan to stay for life quietly begin searching for exits. Gentrification doesn't remove residents with bulldozers. It removes them with spreadsheets. It transforms belonging into liability. And because it's framed as growth, those who struggle under it are often told they should be grateful. But gratitude doesn't pay tax bills. Over time, the neighborhood changes, not by choice, but by attrition. Those with fixed incomes drift away. Those without savings sell under pressure. What remains is a new population that can afford the rising cost of presence. The tragedy is that many of the people displaced never wanted to leave. They weren't against change. They simply couldn't afford to exist inside it. Number 7. Disaster rebuild penalties. Florida homeowners already live with the constant risk of hurricanes, floods, and storms. But what many families don't realize is that surviving a disaster can make their financial situation worse in the long run. When a home is damaged and rebuilt, the county often reassesses its value based on the new structure, not the one that existed before the storm. That means the very act of repairing your home can trigger a permanent increase in property taxes. A family may spend months navigating insurance claims, living in temporary housing, and scraping together enough to rebuild, only to discover that their tax bill has jumped because the home is now considered improved. In effect, resilience is penalized. The system doesn't ask whether the upgrade was a luxury or a necessity. A reinforced roof, elevated foundation, or modern wiring, features added for safety, are treated the same as cosmetic upgrades. The result is a cruel paradox. Rebuilding to survive future storms can make the home harder to afford. For working families, this creates a slow financial aftershock. Insurance premiums rise, repairs drain savings, and then, quietly, the tax bill arrives higher than before. Many households never fully recover. They reduce spending, take on debt, or begin considering selling, not because the storm destroyed their home, but because it changed the economics of staying. Over time, disasters reshape communities, not only through physical damage, but through financial pressure. Those with wealth rebuild and absorb the increases. Those without are forced into difficult choices. A house meant to provide safety becomes a liability tied to unpredictable events beyond human control. What feels like recovery on the surface becomes a long-term burden beneath it. The storm may pass in days, but its financial shadow can last for decades, transforming survival into a new kind of vulnerability. Number 6. Missed payment, legal domino effect. Property tax in Florida operates on a rigid timeline that does not bend for hardship, confusion, or human error. Miss one payment, and the consequences begin quietly stacking up. At first, it looks harmless. A late fee, a notice, a reminder tucked into a pile of mail. But beneath that surface, a legal mechanism is already in motion. Once taxes go unpaid, the county issues a tax certificate, selling your debt to an investor. From that moment, your home is no longer just your home. It is collateral in a financial process you did not choose. Interest begins accruing, fees grow, deadlines lock in. And because this process is administrative rather than judicial, there's no courtroom moment that feels like foreclosure. There's no dramatic warning. It unfolds in steps that feel small until they become irreversible. A family might miss a bill during illness, unemployment, or a move. A senior might not understand a digital notice. A homeowner might assume they have more time. Each delay compounds the problem. What began as a manageable amount becomes something heavier, something harder to recover from. The legal system does not evaluate intent. It does not ask why. It only executes the timeline. And once that timeline reaches its final phase, the home can be sold to satisfy a debt that may be a fraction of its value. This is why property tax loss feels so unfair to those who experience it. It is not driven by recklessness, it is driven by momentum. A series of small oversights becomes a cascade. One envelope becomes a chain reaction. The owner often remains in the home, unaware that ownership itself is slipping away in the background. By the time reality becomes visible, the options are few. The danger lies not in a single mistake, but in how quickly that mistake becomes structural. The system is designed for efficiency, not for second chances, and in that design, ordinary families become vulnerable to extraordinary loss. Number 5. The escrow time bomb. For homeowners with a mortgage, property tax rarely arrives as a single, obvious bill. It hides inside escrow, bundled with insurance and rolled into the monthly payment. This creates a dangerous illusion of stability. You believe your housing cost is fixed, predictable, under control. But escrow is not a shield. It is a delayed amplifier. When the county raises your property tax, your lender recalculates your escrow account. If there's a shortfall, the bank doesn't just adjust future payments. It demands repayment for what you underpaid last year and increases what you must pay going forward. The result is a sudden spike that can feel like a financial ambush. A family paying $1,200 a month opens a statement and discovers their new payment is $1,550. Nothing about their lifestyle changed. Their income didn't rise, their house didn't grow, but the cost of existing inside it just jumped. Many homeowners describe this moment as the first time they felt their home slipping out of reach. Escrow shortages hit hardest when people are least prepared. After a reassessment, after an insurance hike, after a storm, or during economic strain. The increase isn't optional, it's automatic. Miss it, and the account falls behind. Fall behind, and the risk compounds. What makes this so destabilizing is its timing. It doesn't arrive as a warning, it arrives as a verdict. The payment is already due. There's no negotiation window. The homeowner must either absorb the shock or begin falling behind. For families living close to the margin, this is how stability becomes fragility overnight. A house that once fit comfortably into the budget becomes a source of constant anxiety. The payment feels unpredictable, like a moving target. Every reassessment becomes a threat. Escrow transforms property tax from a distant obligation into a monthly pressure point where even small increases ripple into daily life. Over time, this erodes financial confidence. Home ownership stops feeling like security and starts feeling like exposure, where one recalculation can undo years of careful planning. Number 4. Fixed income versus rising taxes. For retirees, a paid-off home is supposed to mean freedom. No rent, no mortgage, just stability. But Florida's property tax system turns that promise upside down. While income often becomes fixed after retirement, property taxes remain elastic. They stretch upward with the market, not with the homeowner's ability to pay. A senior living on Social Security and a modest pension may see their tax bill rise year after year, even though their income stays flat. What once felt manageable begins to nibble at savings. Then it starts taking real bites. Groceries get cheaper, medical visits get postponed, home repairs are delayed. The house may be owned outright, but the cost of keeping it keeps climbing. This creates a quiet form of displacement. There is no eviction notice, no moving truck parked outside, just a slow realization that the numbers no longer work. Seniors begin asking painful questions. Can I still afford to live here? What happens if it rises again next year? Many end up selling not because they want to downsize, but because they are being priced out of the very home they earned. The emotional toll is heavy. These homes hold decades of memory, children raised, partners lost, lives built. Yet the system treats them as financial units, not human spaces. Even with exemptions, even with caps, the upward pressure never truly stops. For those who planned carefully, saved diligently, and avoided debt, this feels like a betrayal of the social contract. The idea that you can do everything right and still be forced to leave is deeply destabilizing. Over time, this pressure reshapes entire communities. Long-time residents disappear. Neighborhoods age out. The people who gave places their character are replaced by those who can afford the new baseline. Fixed income becomes a trap when it is paired with a cost structure that never rests. And what was meant to be a season of rest becomes a season of financial vigilance, where every tax notice feels like a test of whether home is still allowed. Number 3. The inheritance reset shock. Many families believe that when a home is passed down, it carries its history with it, the memories, the walls, and the financial protections built over decades. In Florida, that belief can be dangerously wrong. When a property transfers from parent to child, the tax system often treats it as a brand new asset. Years of capped increases vanish. The assessed value can jump to full market price overnight. What once carried a modest tax bill suddenly reflects today's inflated housing market. For the heirs, the shock is immediate. A home that was affordable for their parents becomes financially hostile to them. Children who hope to keep the family house, maybe to raise their own kids there, maybe to honor a promise, open a tax notice that feels like a warning. You don't belong here anymore. This reset doesn't care about grief, transition, or timing. It arrives when families are already emotionally vulnerable. The inheritance that was meant to provide stability becomes a liability. Some heirs scramble to pay, others take on debt. Many sell within months, not because they want to, but because the new cost structure makes staying impossible. This is how generational wealth quietly evaporates. The house doesn't fall apart, it doesn't get stolen, it simply becomes unaffordable in the hands it was meant for. Over time, this process reshapes who can remain rooted. Homes that once stayed within families for generations begin cycling rapidly through the market. Legacy becomes liquidity. What was meant to anchor a lineage turns into a transaction. The tragedy is not just financial, it is cultural. Stories tied to walls are erased. Neighborhood continuity breaks. Families lose more than property, they lose place. The inheritance reset transforms homeownership from a long arc into a temporary lease, reminding each new generation that what their parents built may no longer be designed to last in their hands. Number 2. The homestead myth. Florida's homestead exemption is often spoken of as a fortress, a guarantee that if you own and live in your home, you are protected. Many homeowners believe it makes them untouchable, that once they qualify, their house is safe from the forces that push others out. The truth is far more fragile. Homestead offers limits, not immunity. It can slow the growth of assessed value, but it cannot stop it. It cannot freeze taxes. It cannot protect against every scenario. And most dangerously, it can vanish in moments most families never plan for. Move out temporarily, rent the home, transfer it incorrectly, inherit it, divorce, place it in the wrong kind of trust. Each of these can trigger a reset that strips away years of protection in an instant. Homeowners who thought they were insulated suddenly find themselves exposed. The system is unforgiving to technical mistakes, a form filed late, an address mismatch, a misunderstanding about eligibility. These are not moral failures, yet they can cost thousands over time. What makes the homestead myth so powerful is how comforting it feels. People stop checking, they stop planning, they assume the shield is permanent, but it is conditional, procedural, and bureaucratic. It exists on paper, not in principle. For many families, the first time they realize this is when the bill arrives higher than expected, or when a child inherits and loses the cap, or when a temporary move breaks eligibility. The sense of betrayal is profound. "I thought I was protected" becomes a common refrain. The myth turns into a trap because it encourages complacency in a system that requires constant awareness. Homestead is a tool, not a guarantee. It reduces speed, not direction. Taxes still rise, values still climb, the floor beneath the home still shifts, and when the protection disappears, it does so silently, without ceremony. Families who built their financial future around the idea of permanence discover that the permanence was conditional all along. The myth doesn't fail because it lies, it fails because it is misunderstood as a promise when it is only a mechanism. Number 1. The surprise reassessment shock. The most dangerous part of Florida's property tax system is not how high it can go, it's how suddenly it can change. Most homeowners assume increases happen slowly, in small, predictable steps. They budget for gradual movement. They plan around stability. But reassessment doesn't always follow that rhythm. A neighborhood becomes hot. A nearby development breaks ground. Market prices surge. And in the next cycle, the county updates your home's value to reflect a reality you never asked for. The house didn't change. Your income didn't change. Your life didn't change. But the number attached to your address did. That single adjustment can ripple through everything. Taxes rise, escrow recalculates, monthly payments jump. What felt like a manageable home becomes a financial strain almost overnight. Families describe it as whiplash. One year they are comfortable, the next they are scrambling. The shock is psychological as much as financial. It breaks the sense of control. You realize that the cost of your home is not anchored to your choices, but to forces outside your reach. This is how stability erodes, not in crisis, but in recalculation. The reassessment arrives as a letter, not a conversation. There is no negotiation built into the moment. The system assumes you can absorb the change. For many, that assumption is wrong. A household living close to the margin doesn't have room for sudden shifts. A retiree on fixed income cannot stretch to meet a market-driven number. A young family already balancing childcare and groceries cannot conjure extra hundreds each month. The reassessment shock transforms homeownership into a moving target. You no longer ask, "Can I afford this house?" You ask, "Can I afford what this house might become?" That uncertainty is corrosive. It turns planning into guessing. It turns a home into a variable. And in that uncertainty, families begin making defensive choices, cutting, delaying, selling, not because they failed, but because the ground beneath them changed without warning. Florida's property tax system doesn't attack in one dramatic moment. It erodes quietly, year by year, notice by notice. It turns stability into uncertainty and homes into moving targets. But awareness changes everything. When you understand the traps, you can prepare, protect, and plan instead of reacting in panic. Your home is more than an asset. It's your family's history and future. If this opened your eyes, hit like so more families can see it. Subscribe for videos that protect your money and your future. And tell me in the comments, has your property tax ever shocked you? Your story might save someone else's home.